Hello, everybody. We're going to give it just a couple minutes. We still have a lot of people joining us right now, so just bear with us a minute. Still adding a few more at the moment. Give us just a couple more moments. All right, looks like it's slowed down a little bit, so we can go ahead and get started. My name is Brian Falls. I'm here at Mueller Financial Services, and the topic of today's webinar is Retirement Minefield. Just a couple of housekeeping things real quick. The chat feature on the webinar has been disabled, so if you have a question, you're going to see my email and phone number at the end. Feel free to reach out to me there, and I'd be happy to follow up with you. At this point, we're not going to be able to provide copies of the slides. Within the next couple of weeks, we're hoping to provide a copy of this presentation on our website, the Mueller Financial Services website. If you're not familiar with Mueller, we are a financial advisory firm. We've been in business for over 30 years now. We provide guidance on to the region, mainly in Chicago, but we have clients all over the country, and we also have an office in Sarasota, Florida. We offer a broad range of financial services for corporations, business owners, executives, independent financial professionals, and high net worth individuals. Now I'm going to bring on two of our product partners here, Nick Arndt and Ben Eno. And Ben is going to start us off by telling us a little bit about Transamerica.
Thanks, Brian. Appreciate the time. Glad to be here with everyone today. My name is Ben Eno. I've been with Transamerica for over 20 years now. And Transamerica is one of the many partners that Mueller Financial Services has. It's a great set of resources to them and everything they do for their clients. And if you're not familiar with Transamerica, we've been around for over 100 years in the industry. We provide everything from investments to retirement planning, life insurance, annuity products, with more than 11 million customers across the board. Beyond all the investment and financial services products that we have, one of the things at Transamerica that we think makes us very unique and different is we really try to go above and beyond just our products to help out with clients and their accounts. We really feel like we're in the business of helping people live well and empowering them to create a better tomorrow through financial and health-related habits they form today. So with that being said, we have created a lot of content, a lot of value-added material, and we have formed a team called our Advanced Markets team at Transamerica. And the speaker today I'm going to introduce in a second, he's part of this team at our Advanced Markets group that are subject matter experts in a variety of topics, Social Security, Medicare, complex estate planning. In today's topic, they're going to go into IRA planning and some of the challenges and difficulties and things to avoid when you work in an IRA. So they cover a lot of information. They have great expertise in this area, and it's absolutely my pleasure to introduce one of the members of the team is a director of our Advanced Markets team at Transamerica, Nick Arndt, and Nick is going to spend the next rest of the presentation walking you guys through. I think is a very impressive and very thorough presentation on the IRA marketplace. So With that being said, thank you again for everyone being here with us. We truly appreciate it, as does Mueller, and I'm gonna go ahead and pass it over to Nick. So Nick, go ahead.
All right, thank you so much, Ben. Hopefully everyone can see the slide has changed now over to the Retirement Minefield presentation, why you all joined us today. It is going to be an overview to help avoid those common IRA mistakes. So do appreciate you taking some time out of your day. One thing we do with this presentation, we give this virtually a lot, but when we're in person, we try to get interaction with the audience. Obviously, I can't do that over a virtual meeting here, but I like to start off by maybe just having you think about, if I asked you how many retirement rules that you could think of that you may come up with some rules around certain investing, like how much percentage of my income should I start investing to gear up for retirement, to have that solid base once I do reach retirement age, or maybe even like what sort of investments in the mix of investments do I need to start investing in, or trying to estimate what my expenses are going to be. I have a pretty good idea what they are today, but what are they going to be in once I reach retirement? And these were kind of once that roadmap to really a sound retirement once we reached age 65. And some of those strategies, they might still hold some water and be a good way to go about it. But we've gone through a recession a few years back. We may currently or soon see one again. We've definitely gone through a pandemic. So the world as we know it's changed, right? It's always changing. Things keep shifting. And this is no reason to really worry about a retirement. It's just like kind of building a healthy lifestyle. You may be able to reach your retirement dreams when you avoid some of those common mistakes. And that's why you all are here today. That's why I'm here today. So for the people on the call today that are near retirement, or maybe you're already in retirement, there are additional challenges that need to be addressed. And when changing from work, we work our entire lives and through our career, and that shift to investing for our retirement, to making sure that our investments are going to last, is really top of mind. And you might also start thinking about, well, am I going to have enough left over to leave a proper legacy to your heirs as well? And retirement income or distribution analysis might or may not take into account some of those unique circumstances for you personally. So you all are unique. You all have unique personal circumstances. And that's really why the general rules for retirement that you hear or that you might read about, they may not work for you. And staying on track and keeping pace in retirement is going to look different for every single one of you that is joining us today. So with that in mind, my goal is to talk about the ins and outs of retirement, and specifically the topic of IRAs, the importance of the personal circumstances you have, and how to help avoid some of those mistakes along your retirement journey. Here I just need to show a slide. You can read through that. This presentation is not meant to be construed as tax or legal advice, nor can I offer legal or tax advice. Now let's talk about what to expect when preparing for that next chapter in your lives, and that being looking forward to retirement. Here's a few statistics we found that we like to share with individuals, and just kind of in your mind think about what retirement kind of looks like for you. So for example, we found some surveys. The most recent one that we had from our Transamerica Retirement Survey of Workers, that's conducted through Transamerica Center for Retirement Studies. 65% of workers are looking forward to traveling once they reach that retirement age, and that's kind of what they're dreaming about. That might be one part of what you're dreaming about as well. Spending time with family and friends, 59%, and or just about half of people are just looking forward to kicking back, relaxing, enjoying their hobbies. But there are going to be some concerns, right? Everybody has those worries once they reach retirement. One of the biggest worries folks have is health and how to pay for it, their personal health. How are they going to go through retirement and pay for their health and make sure that they stay healthy? Because 66% of workers are varied or somewhat concerned about their health in retirement. A little fun fact, not shown on this slide, 70% of individuals who are 65 years old today are going to have a long-term care need at some point in their lives. And then moving on, retirement age and working in retirement, about half of us, on this call, half of the people we talk to out there in the world are expecting to work even past age 65. That kind of was the earmarked normal age for retirement, but about half of us think we're probably going to work past age 65, and 57% may just plan on workers plan to work after they retire. So even if they're retired, they're just going to kind of cut back on the number of hours that they are putting into a job. And their expected primary source of retirement, well, just over half are expecting that the primary source for their retirement income is going to come from their savings, their self-funding, their types of accounts like 401ks that they're investing in now that they're deferring their salary into, or maybe you have a 403b plan, or those IRAs, or maybe just after-tax money savings that you have in investments as well. So that type of self-funding, over half of workers consider that their primary resource for retirement income. So how prepared are you to take on those challenges of providing for your retirement? Not long ago, I can remember reading a bunch of articles titled, how to retire early or how to retire rich, with pictures of retirees on boats or on beaches or in vineyards. And you may have even heard about the FIRE movement, which is financial independence, retire early. The media tends to make retirement seem pretty easy, but more and more people starting to discover that it can be a minefield of risks and potential mistakes. And the reality is that now more than ever, we have to do our best to try and manage those risks that are, some of them are out of our control. So we just need to try to manage them, such as inflation. The March 2023 numbers just came out a couple of days ago. We're still at a 5% year-over-year inflation number. That's well over that normal long-term projection that is used in a lot of your retirement income planning projections of maybe 2 or 3%. Market volatility last year, 2022, that was the worst year that we've seen for both equities as well as fixed income in as many years as I can remember. Typically, if equities are going down, you have an opportunity to try to find some safe haven with those fixed income investments that are thought to be, more of a conservative investment. But that was not the case last year. Both equities and fixed income had a pretty bad year. And then those spending assets, well, in times of high inflation and low or negative even investment returns, that's going to cause a setback to your portfolio sustainability through your retirement as you're taking withdrawals from those accounts. And then the unexpected, this I just kind of view as that wild card. Nobody can foresee what's going to happen to our property values or our income needs, or what's going to happen to our expenses in our savings in retirement. So we're going to talk a lot about IRAs today, and specifically IRAs. It is the #1 topic that my team fields calls on year after year. The overarching topic of IRAs is the #1 topic that we discuss with advisors and their clients. So it may seem pretty straightforward, but all the risks and challenges facing today's retirees and also pre-retirees, avoiding those mistakes need to be the cornerstone of any financial strategy, because as the baby boomer generation is retiring, and you may be one of them, more and more of that money is going to be rolled over into IRAs. So in fact, I've got some statistics. In 2021, there was $723 billion of assets rolled into IRAs. And that was a 31% increase from just 2 years prior in 2019. And then it's projected to surpass $800 billion in the year 2027. So because they're vital, they are a vital role. It's important to focus on IRA planning and avoiding those IRA mistakes, because we need to focus on the issues that we can control, like not falling into that trap of emotional investing. Avoid relying on those rules of thumbs again, because you have individualized personal circumstances, and understanding how to avoid the costly penalties and additional taxes is something we're going to touch on today as well. IRAs may seem pretty straightforward at first glance, when we get going and we're simply just making our annual contributions. We might say, yeah, this is great, but even then, they can start to be confusing because those limits can change. And it definitely can be a bit challenging once we get to the point in making future decisions about moving those assets. And proper knowledge is just one key to building wealth for your retirement. And here are some quotes that we found from some industry professionals. That first quote's from a lawyer, Natalie Choate. She's well known in the industry around IRA planning. She's quoted as saying, "I was surprised at how complicated the process was for me, and I'm an expert." So, take that as you will. Even these lawyers who specialize in IRA planning, the rules and regulations are complicated. So there's nothing straightforward about IRA planning. Another individual, the director of personal finance, Christine Benz, in Morningstar, opening an IRA is a pretty straightforward matter. Yet there are plenty of ways investors can stub their toes along the way. And then the Investment Company Institute estimated that roughly 88% of all eligible taxpayers skipped IRA contributions. Then again, IRAs can be confusing. So, Dan there in the Financial Advisor magazine is recognizing that, yeah, IRAs can be confusing, and a large portion of our population is actually just skipping over even contributing to IRAs. And it's not really surprising why people are not up to date or unable to stay up to date on their tax knowledge. We've seen a handful of tax laws change over the past few years. It seems like just when we get get up to date on the last changes, a new tax bill is signed into law. And the highlighted topics here on this slide were all affected by the most recent tax law bill that was just signed into law at the end of last year in 2022. So are you familiar with all these changes? Most likely not, because I'm not even up to speed on all the intricacies of these changes, because believe it or not, neither is the IRS. Yeah, Congress passes the bill, the president signs it into law, but then we need the IRS to provide us guidance on how to implement some of these new tax law changes. And we're actually needing to wait for some technical corrections due to some errors that were in that bill to begin with. Now, the IRA, rule book, if you will, that's called IRS Publication 590A and Publication 590B. That consists of more than 120 pages, and it's not a fascinating read. The information inside there, however, is going to be very critical, as it covers every type of transaction you'll make with your IRAs. One issue I see with this rule book is that it's always lagging in information. For example, this most recent version was just published a couple of week ago, April 4th. So it covers last tax year, meaning 2022. The 2023 version isn't going to be published until probably sometime in April of next year in 2024. So to really fully digest that information, you really need to dig in and read the actual tax law itself, which, if you think reading the taxpayer version of these publications, 590, try reading the actual tax law. If you're having trouble sleeping, believe me, just start reading the Secure 2.0 Act. That was the last bill signed into law. You will have found a cure for your insomnia. But just to review these highlighted ones that changed: age 59 and a half rules. That is also includes the 10% additional tax, partial rollovers, early distributions, inherited IRAs. That changed a few times over the last couple tax bills that were signed into law, as well as our RMD age. It's currently 72. We'll review that towards the end of the presentation. Our required beginning date, what does that mean? Penalties we need to be aware of. Our beneficiary options, when we're doing beneficiary planning, that's important as well. I'm taking a look at our tax form after we've filed our taxes. It's important to look at our 1040 to kind of see what our financial health is. And then Form 5329, all topics that were affected just a few months ago. So let's look at where most people that we receive calls about where they're making these mistakes and how we try to pinpoint where that hurdle or that hiccup might take place and try to save that individual from a costly mistake. So they typically happen at certain points along the road. If we're looking to do rollovers, there's pros and cons, and we'll go through what might be right for you specifically and some things to ask yourself. When withdrawing income or even making contributions to our IRA accounts, we need to understand the taxes and any possible penalties if we're withdrawing too early and we're not allowed. And what are those deadlines for when we absolutely have to start taking our money out of our IRA accounts? And beneficiary planning, again, that's important. We want to try to take a look at what our beneficiaries' situation is as well, in hopes of leaving some assets to them as a legacy play. So understanding the ins and outs of IRA rollovers is going to help you transfer into that retirement and have a healthy retirement. Let's just start off real briefly, review what is a rollover. A rollover is a transfer of retirement assets from one retirement plan to another retirement plan. So we've got a couple different scenarios here. When we're talking about employer-sponsored plan, those are the qualified plans that we are offered through our employer, like 401ks and 403bs. If we want to take our assets from our employer-sponsored plan and roll it over to our IRA or move it to our IRA, that's a rollover. Now, in a lot of cases, you must be eligible to withdraw those assets from that employer plan. And I'm sorry, you do have to be eligible. And in a lot of cases, we'll go through those triggering events that make participants eligible to withdraw those assets. Also, if we have an existing IRA, but we might want to roll it or move it to a different IRA, that is, again, a different type of rollover where we're going from a like type of account, an IRA, traditional IRA, for example, and rolling it over into a new traditional IRA. So you can roll between IRAs without needing a triggering event. So that's important to understand. And again, we need to take into consideration your personal circumstances, and we'll get into some things to consider as well. So to be eligible for a withdrawal from your employer-sponsored qualified plan, you must have a triggering event in order to transfer or roll over those assets to an IRA. So these might include separation from service. So if you leave that employer has to allow you to move that asset where you would like. If you turn age 59 and a half, that's another triggering event. And also that might be required for what's called an in-service rollover. Or if you become disabled, or if you happen to pass away, that's going to apply to your beneficiaries. So you may be able to roll over from your employer-sponsored plan while you're still employed. That again is called an in-service non-hardship withdrawals, and each employer-sponsored plan is different. So no two plans are alike in this specific topic. So to learn more about your specific, you have to request a copy of that summary plan description from your plan administrator, or maybe you have that last one that they've provided to you. They are required to provide that to you. And it's empowering to understand those options that are going to be available to you. So be sure to keep a copy of that for future reference. And then on the other hand, you can roll over IRA to another IRA at any time without needing a triggering event. So keep that in mind. Now, before you withdraw money from an employer's plan and roll it over, make sure a rollover is going to be right for you, because some situations there's where a rollover makes sense. And some of those here we see pretty commonly. Do you have more than one retirement account? So if you've got like a handful of different retirement accounts, maybe you've switched job. I think they say the average American now through their lifetime has upwards of like 10 different jobs. So, you know, we're kind of moving around to different employers. Have we left our money in our previous employer's plan? So we have multiple different retirement accounts out there, and maybe just consolidating those all into one account is going to be easier for you to manage all of your assets. Or is your plan limited on your investment options? You know, you can expand your investment options to include alternative investments, or maybe even possibly annuities or some other type of alternative investments if you roll it over into an IRA. Typically, your qualified plan through your employer is going to have a set number of investments that you can choose from. And is your plan offer a retirement income program? Some do now. That's another thing that has come up with these new tax law changes, but some still don't. It is plan specific. So IRAs can try to provide a guaranteed lifetime income, or maybe a bond laddering strategy, or bucketing options. Those are all things to consider if an IRA rollover is going to be right. Now, here are a couple more reasons. Is your plan, does it have limited beneficiary planning options? Typically, qualified retirement plans, you are kind of set into a smaller options, fewer options for your beneficiary planning. So IRAs can offer that customization. You could have pre-selected, for example, you can pre-select how your beneficiaries are going to receive your inheritance if you were to pass away, and possibly a stretch beneficiary option is available. You know, you may need or want to access your retirement assets prior to 59 and a half. So IRAs offer additional exceptions to that 10% additional federal tax, including but not limited to health insurance premiums if you're unemployed, qualified higher education expenses, and for first-time home buyers up to $10,000. Those are unique to IRA accounts that qualified retirement plans do not offer. So that said, let's look at some of those situations where doing a rollover might not be wise. So for some people, a rollover from an employer-sponsored qualified plan to an IRA won't make sense right away or at a specific point in time, but it may make sense at some point in the future. So let's look at that flip side of the coin. Some reasons you may want to just be cautious about a rollover. So this is money moving into an IRA from your employer-sponsored qualified plan. You are electing an indirect over a direct rollover. We're going to get into the specifics of what the differences are between those and why you want to pay attention to that. You know, ensure you're doing it the right way. Remember, if that you opt to handle this yourself, you could end up with a taxable event unknowingly or unwittingly, and a penalty for early withdrawal, even if you're prior to 59 and a half. And then that loss of tax deferral on that part of your rollover that was taxable. You're paying the 10% additional federal tax on pre-59 and a half withdrawals. You can see this on your Form 1040 after you file your taxes. So while it may be unavoidable, it is important for you to consider that there are some exceptions to that 10% additional federal tax on early withdrawals. Or you fail to manage your required minimum distributions. As we sit here today, it's at age 72. Starting next year, it is at age 73. Believe it or not, prior to 2023, a missed RMD penalty was the harshest penalty the IRS assessed at 50%. But thankfully, due to the Secure 2.0 Act, starting in 2023, that penalty has gone to 25%. And actually, if that mistake has rectified in a timely manner, it can go down to as low as a 10% penalty for failed required minimum distributions. And we'll get into what required minimum distributions are later on in the presentation. here are what I like to call some red flags to look out for before executing a rollover from your employer-sponsored qualified plan into an IRA. Do you have employer securities in your retirement plan? This is important to understand. If your employer is traded, and has stock, and they offer that to you as an investment option within your 401k plan, for example, have you been investing in your company stock? If so, you want to talk to somebody about what's called NUA. That stands for net unrealized appreciation. It's an important topic to understand, especially if you have a large amount of appreciation on that stock within your 401k plan. So please keep that in mind. If you're investing in your employer's stock through your qualified plan, you need to have a conversation about net unrealized appreciation, NUA. Are you seeking or not seeking professional guidance? Don't just believe everything that you hear or watch. Again, those rules of thumb can be overgeneralized. Sometimes retirement planning is going to be more complicated than you're going to hear about in the news. And are you overlooking your personal circumstances before rolling that money into an IRA? So keep in mind these circumstances where staying in your employer plan may be preferable for the time being, at least. And when dealing with an IRA rollover, here are some questions to ask yourself so that you can take stock of your own situation. One of them is, do you think you may ever need to take a loan? Because once you roll your employer-sponsored qualified plan into an IRA, IRAs do not offer loan provisions. So by rolling those assets maybe to your new company's plan, you may have that ability to still access that money that you rolled over into your new employer qualified plan with their loan provision. And that's something that is going to be outlined in your summary plan description. So again, try to get a copy, or if you have a copy, take a look at your summary plan description and see what it says about the loan provision. Did you separate from service on the year or after you turn age 55? This is important. We all, I think, probably understand, we hear it all the time, 59 and a half, 59 and a half. But there's a special rule if you separate from service at age 55 that you can access your employer-sponsored qualified plan assets without that 10% penalty. So we hear 59 and a half, we think of, okay, I'm prior to 59 and a half, I'm going to have a 10% penalty. That's not the case for individuals who separate from service in the year they turn 55 or after. You can access money directly from your employer plan without having that 10% pre-59 and a half federal tax. And a couple more questions to ask yourself. Do you plan on working past age 72? So that's our current RMD age. Again, starting next year, it's going to be age 73. That's important because if you're going to continue to work past 72, you actually may be eligible to defer taking your RMDs on your qualified retirement plan assets from your current employer. So that's important. If you're not more than a 5% owner of that business, you're still working. The IRS allows this, but again, going back to your plan's specific provisions, you need to understand just because the IRS allows it doesn't mean that every single qualified retirement plan through your employer is going to have that provision. So look at that summary plan description if you're age 72 and still working, and see if you can continue to defer your RMDs from those assets if you don't need the money. And then were the plan assets awarded through divorce? This can get very complicated. It can get overlooked very easily. I think, sometimes there's a lot of bad blood, if you will, when going through a divorce, understandably, of course. And, the ex-spouse might just think, all right, I've been awarded that money. I just want to get it out of my ex-spouse's plan. But hold on, take a couple deep breaths, have a conversation with a professional, understand what that means, because there's an exception to the 10% additional federal tax for an ex-spouse who receives qualified plan assets as what's called an alternate payee under a qualified domestic relations order or a quadro. So if and when you're ready to do an IRA rollover, you want to make sure that you do it right. So what's the difference between rollover methods? Let's take a look at if you find that rollover is right for you and you want to roll it to an IRA, what is going to be best? Be sure to do it right. There are some really minor details, but they're important details to keep in mind, ensuring that transaction's processed properly on all parties involved aside. The old plan, the new plan that's receiving those assets, as well as yourself is signing off on that paperwork. It's all critically important. Common mistakes happen when we're moving our retirement assets. So that is the time that we need to understand these rules the most, because people often, for example, are going to elect an indirect rollover instead of a direct rollover, meaning they want that check just cut to them. They're going to decide to roll it over at some point in the future. But let's take a look at those differences between the different types of rollover methods. An indirect rollover, that's the distribution from a retirement plan made payable to me or you as the plan participant for you to go and cash. And you're going to put it in your checking or savings account. You then have 60 days from when you receive that check to then redeposit those proceeds into another retirement plan or an IRA. That's an indirect rollover. You completed the rollover, but you did it indirectly by taking constructive receipt of those assets first, and then you made the contribution or the deposit afterwards. Versus what is a direct rollover? That's where the distribution goes directly from your employer-sponsored plan to the custodian of your IRA. And employer-sponsored retirement plans, keep in mind, are required to offer this option. So when people elect an indirect rollover, sometimes unknowingly or not realizing that they have an other option of a direct rollover. The plans must allow everybody to accomplish a direct rollover. And then what is a trustee to trustee transfer? This is where the funds in an IRA are transferred directly from one trustee directly to another trustee. And this is the only method available to non-spouse beneficiaries when you are transferring assets that you've inherited as an inherited IRA. Keep that in mind, that's important. If you are a non-spouse beneficiary, so maybe you inherited some IRA assets from your parents, for example, you cannot execute an indirect rollover of those assets. It must be a direct trustee to trustee transfer from the custodian that currently is holding your inherited IRA, and those monies are sent directly to the new custodian that are going to hold your inherited IRA assets. That's extremely important to understand. So let's take a look at each of those options. This graphic's going to show us how an indirect rollover works and its unique challenges. So we're going to start with $100,000 in your 401k plan. Step one of an indirect rollover, you're going to receive a check for 80% of that. And you're asking yourself, well, why is that? Because that plan administrator per the IRS is required to withhold 20% of your indirect rollover amount that is sent off to the IRS. Then in step two, now you have 60 days from the date that you've received those assets from your 401k to deposit that into an IRA or some other type of retirement plan. So if you stop right here and you have, you're going to have a tax problem here because the IRS is going to consider that 80% or the $80,000 in this scenario to be rolled over and tax deferred, but they will consider that 20% or that $200,000 as subject to taxation. They're going to add a 10% federal tax if you don't have an exception if you're under age 59 and a half. So then in step three, to avoid that from happening, you'll have to come out of pocket. You're going to have to come up with that additional $20,000 to add to your IRA or your other retirement plan. So that it totals that 100% or that $100,000. So both are 100,000 withdrawn, and then $100,000 is redeposited into another IRA, for example. So if you complete all three of these steps, you're going to be entitled to a tax refund at the end of the year, right? Because your 401k plan in this example sent $20,000 directly to the IRS. So keep that in mind. You're going to have that $20,000 when you go to file your federal tax return as waiting for you as a refund. But if you elected an indirect rollover, here are the kind of the following rules. I try to really emphasize the importance of understanding. Maybe it is fine for you, but just make sure you understand the 60-day limit that you have. So, we receive a check in the mail. Maybe we set it on the counter and forget about it for 2 weeks. Then we go on vacation for a week. We come back, it's still sitting there for another week. We're already, 4 weeks in, halfway through our 60-day time limit, and we haven't even done anything about it. So also, very, very important, when moving from a qualified plan, the IRS requires them to withhold 20%. And then those amounts withheld must be added to avoid that taxable distribution and those potential 10% additional tax. So if you have that extra 20% sitting in your bank account, okay, that's fine. You know that it's going to be waiting for you there at the end of the year when you file your taxes. But if you want to try to avoid that, an indirect rollover is not the way to go about it. And then for IRA to IRA, there's unique challenges there as well, because the IRS says you are only allowed one tax-free indirect rollover during any 1-year period. So 365 days, that's not a calendar period. So only one time can you take money from an IRA, deposit that check those assets in your checking account, and then redeposit them into another IRA. You can only do that once per 365 days. So that's another reason to take pause and just understand what an indirect rollover means. But fortunately, there's another way, that direct rollover way. So this graphic illustrates how a direct rollover works. We start with the $100,000 from our 401k plan. One step, the entire $100,000, 100% of that is transferred to your IRA or maybe your new employer retirement plan. So by electing a direct rollover, no 20% mandatory withholding. We don't have to worry about that 60-day time clock that we're on. We don't have to worry about coming out of pocket with that additional 20% that was withheld, and then we're not waiting for that tax refund of that 20% that was sent to the IRS on our behalf. So you can see, much easier, much cleaner. As we've just learned, anyone who wants to maintain that tax deferred status for retirement assets may be better off electing a direct rollover instead of an indirect rollover. And keep in mind that the qualified retirement plans are required to provide this option. I think that's key. And ensuring that the transaction is processed properly by all parties, again, very critical. Believe me, there's a lot of examples where one of the parties just misunderstood the transaction and either sent the wrong paperwork or processed it incorrectly, and something was ran afoul, and there was an unnecessary taxable event. You don't want one of those mistakes, and so we need to avoid that in the future. So you can see here, IRA rollovers can really get a bit complicated, but once your assets have been properly rolled over to an IRA, now there are some helpful rules to follow when you decide to start withdrawing money from your IRA. So let's move on to those rules. But here we see again, I cannot emphasize enough, direct rollover is the route to go unless you fully understand what an indirect rollover is going to need to accomplish, and you're comfortable with that. So when it comes to IRA withdrawals, there are some important milestones to consider. If you take money out of your IRA prior to 59.5, you're going to be subject to a 10% additional federal tax. But once you reach age 59 and a half, you can access that money in your IRA with no tax penalties. However, if you leave that money in your IRA, the IRS is going to force you to begin your required minimum distributions currently once you hit age 72. So that time between age 59 and a half and 72, there's no restrictions, no penalties. You can withdraw your money at any time that you need it. The first required minimum distribution is going to need to be taken by April 1st of the calendar year following the year you turn 72. We're going to get into that in much more detail here. This slide still says failure to take your RMD is 50%. That's not true starting this year, so I apologize. I did not catch that error on our slide here on this specific slide, but I did on those other ones. That was the old rule prior to 2023. Starting in 2023, it's now a 25% tax, and it could be as low as a 10% tax for failing to take our required minimum distributions. So let's look at how the timing of IRA withdrawals can impact your retirement plan. We're going to focus now on this slide, withdrawals made prior to 59 and a half. There are some general exceptions that apply to both employer-sponsored retirement plans, so like 401k plans and IRAs. And we won't be discussing every single exception, but here's just a few. Again, death, disability, medical expenses over 10% of your AGI, birth or adoption of a child up to a $5,000 limit. We're going to discuss substantially equal periodic payments in another slide. And the IRAs have several additional exceptions to the 10% penalty that are just specific to IRAs. So those are higher education expenses, first-time home buyer up to a $10,000 limit, and health insurance premiums while we're unemployed. And then once you reach age 59 and a half, I'm sorry, so we also have exceptions that are specific to our qualified plans. Two of them here that we talk about, I covered via a divorce. If we're an alternate payee per that qualified domestic relations order or that quadro, you can access those monies prior to 59 and a half without a 10% penalty. Or if you separate from service in the year you obtain age 55 or after, you can access your money directly from that qualified plan without a 10% penalty. So then once you reach 59 and a half, you've crossed that age threshold for any of those 10% additional taxes, and you're just exempt moving forward. So we've covered some of these issues earlier in the presentation, which are going to illustrate the importance of your personal circumstance. But I do want to spend some additional time on one exception that's going to apply to everybody, and that's called the substantially equal periodic payment. Sometimes it's referred to as SEP with two P's. This exception does have a lot of terms and conditions, so it can be extremely difficult to make sure that we're following these rigid guidelines. You know, make sure you get some guidance from a knowledgeable professional before moving ahead. But here is the gist of it. If you need to access money prior to 59 and a half, the amount that can be withdrawn is going to be limited, and the IRS gives us three different options for calculating how much we can receive in this substantially equal periodic payment program. And then if we fail to abide by these rules, it could actually result in a retroactive penalty on all of that interest and those distributions. So keep that in mind. We want to talk to an individual who is savvy with these types of programs. The substantial equal periodic payment has to continue for the longer of 5 years or until we're 59 and a half. So if we start one of these at age 50, we have to continue it for 9.5 years. That's a long time to commit to a very rigid payment program. So now let's talk about what happens when we leave our assets in our qualified IRA account too long, and the IRS is going to require us at some point in the future to start making withdrawals. So I'm going to use this timeline to illustrate how required minimum distributions are going to work. This here, the IRS doesn't let us leave all of our assets in our IRA forever. This year, age 72. So if you were born in 1950, you turned 72 last year, you've had a required minimum distribution. If you're born between 1951 and 1959, your required minimum distribution age is 73. So your RMD is going to be based off of your December 31st value of the prior year divided by your life expectancy that they provide us in publication 590. But for today, we're just going to assume age 72 and go from there. So when your 72 year comes, that first distribution year kicks in, and you can take that RMD that year, or the official beginning date, what's called the required beginning date, is April 1st of the following year. So in other words, the IRS is going to give you a break on taking that first RMD because you can defer it until April 1st of the next year. But there's going to be a catch because they only give you a break on that first one. After that, you have to take your distributions for each year by December 31st. So that means if you defer that first one to the next year, you're going to have 2 required minimum distributions, 2 taxable events in that same year. Sometimes that's an important consideration that's overlooked. So please keep that in mind. And then a missed RMD payment, that's going to be subject to a 25% tax starting in this year, 2023. Used to be 50%. You don't want to mess this up. You know, some things that you want to consider, you know, automating your withdrawals. A lot of custodians allow you to just fill out a form. They're going to send and make sure that you get your RMD taken care of each year, or that percentage that needs to be withdrawn is going to increase each year. So, you know, kind of setting it up as a systematic form of payment, you can ensure that you're getting the required amount that you need. You know, create a plan. If you don't need your RMD, what are you going to do with it? You can reinvest it. You could maybe gift it to a loved one. Talk to somebody about what's called a qualified charitable distribution if you have giving needs, and then understand how it fits into your retirement income as well as your estate plan. So, you know, once again, you can see what an important role personal circumstances are going to play in your retirement planning process. So now to the last section, we'll discuss beneficiary planning. This changed in the original Secure Act, which was signed into law at the end of 2019. This is extremely important. I think having IRA beneficiary review is important to understand what are the different options. So surviving spouses, always going to have the most options available to them. They can take it as a lump sum. They can defer it out for 10 years. They could roll it into their own IRA. They're the only beneficiary that's allowed to roll it into their own IRA as a surviving spouse, or they can continue the deceased IRA, and that's the spousal options only. That middle box on this screen, extremely important to understand. This is what came into existence with the original Secure Act at the end of 2019. They essentially created an entirely new category of beneficiary. These are what's called an eligible designated beneficiary. So these individuals are still allowed to elect a lifetime stretch option. And that's a surviving spouse, a beneficiary who is not more than 10 years younger than the owner. So anybody older or all the way up to not more than 10 years younger is allowed to stretch. A minor child of the original account owner only up until they reach the age of majority, which is age 21, unless they're in schooling. Once they reach that age of majority, then a 10-year distribution window is required. Or if they qualify as a disabled individual or a chronically ill individual, they are still allowed a stretch inherited IRA option. So what is a stretch inherited beneficiary IRA? There are required minimum distributions used each year. We look at the single life expectancy table to figure out what that factor is. It allows that beneficiary to maintain tax deferral on that inherited IRA and really control the taxation of large distributions to the extent that, you know, the IRS is going to allow you to still take those required distributions, but you can time when you want to take larger amounts out. And then non-spouse designated beneficiaries, they can only elect a trustee-to-trustee transfer to a properly titled inherited IRA. So keep that in mind. You cannot do an indirect rollover if you're a non-spouse beneficiary of an inherited IRA. So the stretch distribution option, if that's available, here's how it's going to work. We illustrated here for you. 54-year-old, under those stretch guidelines here, we have a $100,000 IRA. We're going to look at the IRS single life factor for this individual. For a 54-year-old is 32.5 years. That first distribution is required to come out by December 31st of the year following the original owner's death. And then each year after that moving forward, 32.5 is subtracted 1. We reduce it by 1 each year moving forward, meaning for this 54-year-old, their life expectancy is 32.5 years. So if they reach age 86.5, that account is going to be fully liquidated. Their factor will be less than 1 in that year. They're going to have to fully liquidate whatever is left in that inherited IRA if they reach age 86.5. So we've covered a lot about the complexities of just one of those retirement factors, which are IRAs, in the hopes of really helping you avoid those mistakes that people often make. So to wrap up, I'd like to leave you with just some important questions to really ponder about, think about, ask yourself, talk with your loved ones. Maybe if you're married, talk with your spouse, before you do anything with an IRA. What is your personal circumstance? What is your personal needs? And what are your personal concerns? So just doing that is going to help you avoid some of those costly mistakes. While there are some concerns in retirement planning that we can try to manage, there are several that we can avoid completely with the proper planning. So, before your next talk with Brian or a financial professional, take these extra steps so that your conversation can be actionable and fulfilling. So maybe complete some sort of IRA rollover questionnaire. We have one available that you can utilize if you want to try to spark some of those questions that we asked here in this presentation and think about them. Obtain that employer's summary plan description if you have an employer plan through your work. Gather your beneficiary information and then take those next steps to really get down and do the planning today so that we can help make sure you're having a fulfilled retirement. So with that, I know I came almost right up to the hour. I do appreciate everybody taking some time out of your day today to listen to our Retirement Minefield presentation. I'm going to turn it back over to Brian.
All right. Thank you, Nick. That was excellent. I appreciate that. Bear with me 1 second here. There we go. Should be able to see my contact information there on the screen. If you have any questions, feel free to reach out to me, or if you work with someone here at Mueller, that individual would be more than happy to help you as well. I do want to thank Ben and Nick today. I hope everyone got something out of the presentation. It was very good, very well presented, Nick. Thank you. And with that, we will finish up for the day. Feel free to reach out if you have any questions. And keep an eye out on our website for this presentation.